Hello everyone, welcome to the 69th episode of me learning how to trade in Forex. So in the last video we went through how to trade the head and shoulders pattern, basically shoulder, head, shoulder, and we've got the neckline here, got the uptrend going up. The length of top of the head to the neckline is pretty much how much the price is going to raise or drop. We met the inverse head and shoulders, basically the opposite of whatever head and shoulders are. And yeah, and now we're on how to trade wedge chart patterns. So yeah, let's get started. So where's it just gone? How to trade wedge chart patterns. Date is 9th of the 3rd. Right. In a wedge chart pattern, two trend lines converge. Two trend lines converge in a wedge chart pattern. It means that the magnitude of price movement within the wedge pattern is decreasing. So, original wedge chart pattern, meaning the magnitude of price movement within the wedge pattern is decreasing. The magnitude, so the bigness of price movement within the wedge pattern is decreasing. Wedge signals a pause in the current trend. Wedges signal a pause in the current trend. Wedges signal a pause in the current trend. When you encounter this formation, it signals that Forex traders are still deciding where to take the pair next. So it's like a undecision thing, indicator, or not an indicator, but like an undecision signal. Wedge signal that Forex traders are still deciding where to take the pair next. A falling wedge is a bullish chart pattern that takes place in an upward trend, and the line slope down. A rising wedge is a bearish chart pattern that's found in a downward trend, and the lines slope up. Right, okay, so a falling wedge is a bullish pattern in an upward trend with the lines slope down. A rising wedge is a bearish pattern in a downward trend with the lines slope up. Wedges can serve as either continuation or reversal patterns. Right, okay. Wedges can serve as either continuation or reversal patterns. The rising wedge. A rising wedge is formed when the price consolidates between upward sloping support and resistance lines. So whoops, this is the falling one. Rising. A rising edge is formed when the price consolidates between upward slope support and resistance resistance lines. Here, the slope of the support line is steeper than that of resistance. The slope of support line is steeper than the resistance line. This indicates that higher lows are being formed faster than higher highs. Higher lows are being formed faster than higher highs. This leads to a wedge-like formation, which is exactly where the chart pattern gets its name from. Higher lows are being formed faster than higher highs. Steeper than that resistance. Oh right, I see. So, well, because the gradient here is steeper, so whatever happens here is doing faster than whatever happens over here. So the price is forming faster. Right, okay. Meaning that higher lows are formed faster than higher highs. This leads to a wedge-like formation, which is exactly where the chart pattern gets its name from. Right, okay. With prices consolidating, we know that a big splash is coming, so we can expect a breakout to either the top or bottom. So either through here or through here. If the rising wedge forms after an uptrend, it is usually a bearish reversal pattern. So it's going to drop down then. On the other hand, if it forms during a downtrend, oh no, this is a downtrend, it could signal continuation of the down move. So it's still going to go down. It could signal continuation. Either way, the important thing is that when you spot this Forex trading pattern, you're ready with your entry orders. Here, like that. In this first example, a rising wedge is formed at the end of an uptrend. So if it's an uptrend, it's usually a bearish reversal pattern, so it's going to drop down again. Notice how price action is forming new highs, but at a much slower pace than when the price makes higher lows. So new highs are like here, but then the higher lows are like rising up here. Price makes a nice move down. See how price broke down to the downside? That means there are more Forex traders desperate to be short than be long. So they push the price down to break the trend line, indicating that a downtrend may be in the cards. Just like in the other Forex trading chart patterns we discussed earlier, the price movement after the breakout is approximately the same magnitude as the height of the formation. So that bit here. But how do you know which bit you will look at? Like, how do you know you shouldn't be looking at this bit instead of that bit? Or, oh, I guess this is where it goes down, so picked here. But then you could just start the trend from here instead, and it also work. But upward sloping support resistance lines. Right, okay. Now let's take a look at another example of the rising wedge formation. Only this time it acts as a bearish continuation signal. As you can see, the price came from a downward trend before consolidating and sketching higher highs and even higher lows. So this is the what is it called? A falling wedge, right? Yep. So this is a falling edge. Do that. Do that. Do that. Do that. Falling wedge. As you can see, the price came from a downtrend before consolidating and sketching higher highs and even higher lows. Higher highs, but the highest lows is rising faster than the higher highs. Same as this one. Price broke down, downtrend resumes. So like this, like that. In this case, the price broke down to the downside and the downtrend continued. That's why it's called a continuation signal, yo. But then it also says it's a reversal, as in like because it was an uptrend, it reversed to make it downtrend. Right, I see. See how the price made a nice move down? That's the same height as a wedge. What did we learn so far about these Japanese candlestick chart patterns? A rising wedge formed after an uptrend usually leads to a reversal, whilst a rising wedge formed during a downtrend typically results in a continuation. Simply put, a rising wedge leads to a downtrend, which means that it's a bearish chart pattern. The falling wedge, just like the rising wedge, the falling wedge can either be a reversal or continuation signal. Oh wait. Oh, this is still the rising wedge, but it's just a for a different, like either going uptrend or downtrend. Right, okay, so these needs to be moved to down here. That. Like that. So if I do that, what did they call it? You can see downtrend, rising wedge acting as a bearish continuation signal. So then a rising wedge formed after an uptrend usually leads to a reversal, which is the downtrend. A rising wedge formed after a downtrend usually leads to a continuation downtrend. Simply put, a rising wedge leads to a downtrend. Either way, whether it's an uptrend or a downtrend. So, falling wedge. This is where we go scroll back up to the falling wedge bit. Boom, boom. Just like the rising wedge, the falling wedge can either be a reversal or continuation signal. As a reversal signal, it is formed at the bottom of a downtrend, indicating that an uptrend would come next. As a continuation signal, it is formed during an uptrend, implying that the upward price action would resume. Unlike the rising wedge, the falling wedge is a bullish chart pattern. So, boom, boom, boom. In this example, the falling wedge serves as a reverse signal. After a downtrend, the price made lower highs and lower lows. So, the lower highs and lower lows. What's lower high? What's a lower high? Wait. High, low. Lower highs. What's a lower high? Wait. High, low, higher highs. Higher highs, that's that. Lower lows, that's that, isn't it? Higher lows. Low. Wait a second. Low. Lower highs, lower lows. But what's the difference between higher high and a lower high? They're both up here though, aren't they? After downtrend, the price made lower highs and lower lows. Oh, do they mean lower highs and lower lows as in just the price being lower, or the high price being lower and the low price being lower? Well, right, that would make sense because the price from here and it dropped all the way to here, so the highs, the high price is dropping lower, so it's lower highs, and then in up here, higher highs. That means the high price over here is becoming is increasing, so it's becoming higher. Right, okay, right, I see. Lower low, so the lower price of this, of each candle, is becoming increasingly lower because it's a I guess a negative gradient here. Not a negative gradient, that doesn't make sense. A negative slope here, so it's going downwards. Right, okay. Notice how the falling. Okay, right, I get it now. I get it. Where are we? Here we are. Now, notice how the falling trend line connecting the highs is steeper than the trend line connecting the lows. Yep. So, let me just grab this. Where have I just put it in the wrong place? No, I have not. Where has it gone? Oh, there we go. Right, okay, yeah, that makes sense. Right, upon breaking above the top of the wedge, the pair made a nice move upwards that's approximately equal to the height of the formation. In this case, the price rally went a few more pips beyond that target. Let's take a look at an example where the falling wedge serves as a continuation signal. Like we mentioned earlier, when the falling wedge forms during an uptrend, it usually signals that the trend will resume later on. So we've got that one here. Like that. Copy. In this case, the price consolidated for a bit after a strong rally. This could mean that buyers simply paused to catch their breath and probably recruited more people to join the bull camp. It looks like the pair's revving up for a strong move. Which way would it go? Upwards. Let's get a better photo of that. See how the price broke to the top side and went on to climb higher? Yep. If we placed any entry order above that falling trend line connecting the pair's highs, we would have been able to jump in on the strong uptrend and caught some pips. If we placed an entry order above that falling trend line connecting the pair's highs, above that falling trend line connecting the pair's highs, so like somewhere over here, we would have been able to jump in on a strong uptrend and caught some pips. A good upside target would be the height of the wedge formation. If you want to go for more pips, you can lock in some profits at the target by closing down a portion of your position, then letting the rest of your positions ride. Yep. Whoa, what was that? Right, okay. So, that's that lesson done. Using how to use rectangle chart patterns to trade breakouts. Right. How to use rectangle chart patterns to trade breakouts. A rectangle is a chart pattern formed when the price is bounded by parallel support and resistance lines. So a rectangle is a chart pattern formed when the price is bounded by parallel support and resistance lines. A rectangle exhibits a period of consolidation or indecision between buyers and sellers as they take turns throwing punches, but neither has dominated. A rectangle exhibits a period of consolidation or indecision between buyers and sellers. The price will test the support resistance level several times before eventually breaking out. The price will test supports and resistance levels before eventually breaking out. From there, the price could trend in the direction of the breakout, whether it is the upside or downside. So it's just like a ranging thing. Like that. Cool. In the example above, we can clearly see that the pair was bounded by two key price levels, which are parallel to one another. So we've got resistance here, support here. We just have to wait until one of these levels breaks and go along for the ride. You can see that the price tests resistance here, support here, resistance here, support here, resistance here, support here, resistance here. Remember, when you spot a rectangle, think outside the box. Bearish rectangle. A bearish rectangle is formed when the price consolidates for a while during a downtrend. A bearish rectangle is formed when the price consolidates for a while during a downtrend. This happens because sellers probably need to pause and catch their breath before taking the pair any lower. Stuck in a box. is it going to continue to go down? In this example, price broke the bottom of the rectangle chart pattern and continued to shoot down. If we had a short order just below the support level, we would have made nice profit on this trade. Right, okay, so if it goes down, if a rectangle appears after a downtrend, does that mean it's always going to continue to go down though? Or could it go back up again? Also, I think this is like a take profit level, which is like about here, isn't it? So to not be greedy, because even though the price continues to go down, we don't really know when it will shoot back up again. So this is like the safe take profit level, I think. So here's a tip: once the pair falls below the support, it tends to make a move that is about the size of the rectangle pattern. In the example above, the pair moved beyond the target, so there would have been a chance to catch more pips. Bullish rectangle. Here's another example of rectangle, this time a bullish rectangle chart pattern. So a bullish rectangle is formed when the price consolidates for a while during an uptrend. And after an uptrend, the price pauses to consolidate for a bit. Can you guess where the price is headed next? It will go up. It will go up. If you answered up, then you're right. Check out the nice upside breakout right there. Very nice. Price pops up by the same height and so much more. Notice how the price moved all the way up after breaking above the top of the rectangle pattern. If we had a long order on top of the resistance level, we would have caught some pips on the trade. Just like in a bearish rectangle pattern example, once the pair breaks, it will usually make a move that's at least the size of its previous range. Do I look like I'm breaking out? Nice. Okay, next lesson. How to trade bearish and bullish pennants. And bullish tenants. Pennants. As well as pennants. Similar to rectangles, pennants are continuation chart patterns formed after strong moves. Pennants are continuation chart patterns formed after strong moves. After a big upward or downward move, buyers or sellers usually pause to catch their breath before taking the pair further in the same direction. Because of this, the price usually consolidates and forms a tiny symmetrical triangle, which is called a pennant. Symmetrical triangle. What is symmetrical about this triangle? Is it that? Oh no, it's that grey line thing. Oh wait, let me just get a better photo. Right, okay. That's price usually consolidates and forms a tiny symmetrical triangle, which is called a pennant. So the grey rectangle then, maybe, basically. Whilst the price is still consolidating, small buyers or sellers will usually decide to jump in on the strong move, forcing the price to bust out the pennant formation. Okay, so this is the rectangle. This triangle, I mean, is the pennant. So after a big upward move, buyers or sellers usually pause to catch their breath before taking the pair further in the same direction. Because of this, the price usually consolidates, so down, up, down. More buyers or sellers usually jump in on the strong move, forcing the price to burst out the pennant formation. Right, okay. Bearish pennants. A bearish pennant is formed during a steep, almost vertical downtrend. So, a bearish pennant is formed during a steep, almost vertical downtrend. After that sharp drop in price, some sellers close their positions whilst others decide to join in the trend, making the price consolidate for a bit. Right, okay, so we can see that triangle is the pennant, as they call it. So that triangle there is that grey triangle here. As soon as enough sellers jump in, the price breaks below the bottom of the pennant and continues to move down. So that height there is still the same as that height there. As you can see, the drop resumed after the price made a breakout to the bottom. To trade this chart pattern, we put a short order at the bottom of the pennant with a stop loss above the pennant. So, to trade this chart pattern, put a short order at the bottom of the pennant with a stop loss above the pennant. Right, okay, so put a short order at the bottom of the pennant. So by bottom I mean like here or here? I'm assuming like here? No, but then you will need to know that, because if you place a short order here, then you're not, no, place it over here, because then you would actually know the pennant's actually formed, so you can put it here with a stop loss above the pennant. So stop loss would be like somewhere around here maybe. That way would be out of the trade right away in case the breakdown was a fake out. Right away in case the breakdown was a fake out. The breakdown. Yeah, you do it here. Yeah. Unlike the other chart patterns wherein the size of the next move is approximately the height of the formation, pennants signal much stronger moves. Usually the height of the earlier move, also known as the mast, so here, it is used to estimate the size of the breakout move. A bullish pennant. So a bullish pennant is formed during a steep, almost vertical uptrend. Bullish pennant, just like his name suggests, signals that bulls are about to go charging again. This means that the sharp climb in price will resume after that brief period of consolidation, when bulls gather enough energy to take the price higher again. So, like here, like that. In this example, the price made a sharp vertical climb before taking the breather. So, vertical climb, breather. I can hear the bull stomping and revving up for another run. And it does a vertical breakout, or an upwards breakout. Just like we predicted, the price made another strong move upwards after the breakout. To play this, we will place our long order above the pennant and our stop order below the bottom of the pennant to avoid fakeouts. So, to trade this chart pattern, puts a long order at the right. Where would you put the long order? You put it here, wouldn't you? Like at this point here. So at the bottom of the pennant, and with a stop loss below the pennant. So if it's an uptrend, yeah, below the pennant. Below the pennant. Put a long. I should probably move this. Let's move this bullet chart here. Delete that. Put it here. So to trade this chart pattern, put a long order at the bottom of the pennant. So put it here with a stop loss below the pennant. So like here, right? To exit if it's a fake out. To exit if it's a fake out. Yeah, and then above the pennant, long order above the pennant. I'll stop below the bottom of the pennant. Long order above the pennant. Put a long order above the pennant, stop below the bottom of the pennant. the top. Wait, at the top of the pennant. Put a long order at the top of the pennant. So like here, put a long order here. And the stop loss below the pennant. So put stop loss here. Yeah, but you can't just... Surely you put it here though, wouldn't you? Why would you put it here? Because if you do put it here... Yeah, but how would you know which candle to put it? You have to look the next one, wouldn't you? Because what if the next one is still going upwards though? Like we discussed earlier, the size of the breakout move is around the height of the mast or the size of the earlier move. You see pennants may be smaller size, but they could signal huge price moves, so don't underestimate them. Before at the bottom. The price breaks below the bottom of the pennant. So I think this is the bottom of the pennant, isn't it? Because it says breaks below, so it breaks below that. As you can see, the drop resumed after the price made a breakout to the bottom. Yeah, this is the bottom of the pennant. Right, okay, so it is at the point bit then, basically. Right, okay, that makes sense then. So put long order at the top of the pennant. So around here. Wait, above the pennant. So like here, put long order here or here. Stop loss below the pennant. Stop loss here. No, yeah, you place a long order here and stop loss here, or stop loss here if it's to exit if it's a fake out, because we can't put a stop loss here because that would go below that, so it triggers stop loss, but we don't want that because it will still go up again. So put a stop loss here. That's what I'm getting at. So it's really confusing, this is actually. Yeah, maybe I think it would make much more sense if there's like a practical example of doing this, because then we would actually be able to draw the lines on it ourselves. And I guess like that comes into demo account stuff, making demo account trading in a demo account, but which is going to come on later on. But it would just be nice to have a, you know, a little play with like current price charts and just draw some lines on it, you know. So okay, well, I'm gonna leave this episode here. There's there's a lot of rambling from me going on in this video, so my bad, I guess. But yeah, in the next episode we're going to cover how to trade triangle chart patterns. So until then, not until then, I'll see you guys next time. Peace. Oh, actually, thank you guys for watching, and I'll see you guys next time. Peace.